I think the question we want to start with, which we don't ask very often, is why are things okay? We've had this year of turbulence. There was the Silicon Valley bank crisis, FTX, all of the things that Ash mentioned, and at least in the US, the economy has held up. Why is that, Bob?
Well, I think to understand why the U.S. economy has held up, but also European economies have reasonably held up, and Asian economies have been weaker as you go around the world. Basically, the distinguishing characteristic and the place you have to start is to understand the policies to get out of the pandemic, the differences in those policies, and the leftover effects of that. So when you're saying, why are things okay, the reason you ask that question is because we just had a big interest rate hike, right? We just had a big interest rate hike. You would think after a big interest rate hike, you'd have a downturn. And so I think, though, to understand the impact of the interest rate hike, you have to look at the conditions leading into it. And so if you go back to 2020 and the pandemic, the response to the pandemic in the United States was the strongest. And it took the form of what we call MP3, Monetary Policy 3, which is a combination of the printing of money and fiscal stimulation. Mm-hmm. Keep in mind, at that time, interest rates were zero, right? So there was no room to cut interest rates to stimulate the economy. So really the only way to do it was for the central bank to print the money, and then for the government to pipe that into the economy. And that was a super powerful form of stimulation, because literally when the government pipes that money into the economy, they're literally just augmenting incomes. It's helicopter money, right? And so it's going to every income group. It's going to the middle class especially, but all income levels. And so once that money was piped into the economy, it got spent. Okay, and now once that money is spent, that produces income. And when that produces income, that income gets spent. It boosted corporate profits. And so that set in motion the conditions that produced the inflation. But the essence, I think the essential thing to focus in on there is that the result of those policies in the US, Europe, and UK, and a number of other countries, was a very high level of nominal spending. And when we talk about growth, we usually just refer to real growth, real GDP. In fact, when the statistics are reported, they only talk about real GDP in the newspaper, right? But the key thing is nominal GDP. Nominal GDP is the first reality of an economy, because we all spend money, right? We earn nominal income. Corporate profits, revenues are nominal. It's all just how many dollars you get. How many dollars you spend, how many dollars you get. And then from nominal spending, it breaks down into growth and inflation, which is a function of how much supply there is. So you have to keep in mind that leading into the tightening in the US, you had 10% nominal GDP growth. That's just a lot of money getting spent, right? And so the tightening, the rise in interest rates, has actually reduced nominal spending a lot, from 10 down to 5 or 6. But still, 5 or 6% nominal growth is much higher than it's been for the last 20 years. Mm. And so if you have, let's say if you have 6% nominal growth, then that's going to break down into some amount of real growth and some amount of inflation. And so if you get 2% real growth, you get 4% inflation. If you have 4% inflation, you have 2% real growth, right? So how much of that nominal spending is absorbed by prices is the first thing, and what's left over is essentially real. So the big thing is that the tightening started from a very high level of nominal spending. That nominal spending was much too high in relation to output, and that produced inflation. And most of the decline in nominal spending passed through to a decline in inflation, not to a decline in real growth. It's partly because companies receive that nominal spending as revenue, and that it's, so long as they have pricing power, that passes down to the profits. And now if companies are profitable, then they don't do layoffs. And if you don't do layoffs, then people still have income and then they spend. And so then what you get is wages. You get higher wages as a result of that spending. So in order to really bring wages down ultimately, which we'll get to, I know, you really have to, you have to soften labor markets, which we've not done yet, right? Everything's okay because of that spending. But you need to soften labor markets. But there's never been a rise in the unemployment rate of any substantial magnitude without a decline in corporate profits. So if you need a 2% rise in the unemployment rate to bring wages down, bring inflation down, you need about a 20% decline in earnings to accomplish that. So there just hasn't been enough tightening yet to actually bring nominal spending down by enough, to bring inflation down by enough, to bring corporate profits down by enough to produce layoffs and a contraction in labor markets and a contraction in income. So we're still just working our way through all of that excess spending, and I think that's the key thing to get your head around. Now, there are other secondary effects of that, like improvement in household balance sheets. There's a lot of liquidity in the banking system, and so on and so forth, that continue to fuel that. But it ultimately emanated from the high level of spending produced by those policies of printing money, and because of that, or is reflecting that, you don't have the same conditions in Asia.
Right.
Because they didn't follow those policies. So if you want to understand what's going on with inflation and growth, you recognize you have very different conditions in US, Europe, and the UK versus China and Asia, and trace that back to the differences in the policies to the pandemic.
Well, yeah, I mean, so I think, Sharon, we'd like to talk about the European view as well, because I think Europe has lagged slightly behind the US, as it's want to do. But yeah, what's your perspective?
Yeah, it's definitely been weaker. I like that point about inflation, because we just had a China inflation print in the last few days, and it was 0. And was certainly nowhere near 0 in Europe or the US at the moment. So absolutely, I think we're seeing the legacies of those different policies. European growth hasn't been as robust as the US. So I agree. I'm talking about real growth here. Real growth in the US in the third quarter is growing above 3%. It will probably dip a bit in the fourth quarter. People are having to pay their student loans back again. There's been some strikes. There's a potential government shutdown as well in the fourth quarter. But even generally, overall for this year, we think the US economy will expand in real terms by 2%. So that's not a recession. That's good. And you're not seeing profits fall because we're not in recession. And nominal growth is even higher because we have some inflation, absolutely. In the case of Europe, we think growth will be closer to 0 this year. A little bit positive overall, about 0.5% for Euro area in real terms. So much, much weaker. And similar in the UK, weak growth in the UK as well. The place in Europe which is definitely in recession is Germany. Germany will be in recession this year, already has been in recession, and Germany kind of is at the epicenter of Europe's problems. So if you understand what's happening in Germany, you kind of understand the difference between Europe and the US. So Europe also stimulated through the pandemic as well, I agree, and we're seeing the result of that in tight labor markets, we're seeing the result of that in higher inflation. But there's some differences for Europe. One is there's a war in Europe at the moment. Energy prices have shot up. They may have come down from their peaks, but they're still relatively high versus pre the war in Ukraine. And it's meant a few things, particularly for Germany. Europe doesn't have energy independence, unlike the US. So you're starting to see certainly energy-intensive industrial production move out of Germany and into the US and other places where it's cheaper. So Germany suffered a kind of hollowing out, I would say, of industry. And then add on to that the weakness in China. China's recovery has been weaker, and Europe is super exposed to that because I often think of Europe as a large open economy, and the US more as a large closed economy almost. The US can kind of generate its own growth, it's got its own energy independence, etc. Europe is very dependent on global growth. The US has been good for Europe in that sense, but obviously Asia and China in particular have been much, much weaker. And Germany, again, at the epicenter of that. So I would say weaker China recovery than expected, higher energy prices and a bit of deindustrialization. And then finally, in the case of Germany, It's got a much bigger manufacturing base than most other economies in developed markets, and manufacturing tends to be much more sensitive to higher interest rates than services do. Again, I think it's been hit by that, and it's been hit by a little bit of an inventory cycle correction as well. So there's lots of things going in there, and has caused a modest recession in Germany. But the rest of Europe, you're still seeing, I think, the tail end of the benefits of all the furlough money, people spending on travel and tourism. You'll see the airports packed if you're traveling. You'll see it difficult to find a table at a restaurant. You'll see hotels fully booked, etc. That's all quite inflationary, really, still. It doesn't feel like a deep recession.
Great. I mean, that brings me to my next question nicely. So the guessing game last year was, when is there going to be a recession? Everyone said it was going to be 2023. That obviously hasn't happened. I think the guessing game now is where are interest rates going to go? And part of that is obviously, well, not part, a majority of that is driven by inflation. And we were talking about this, Sharon. I like how when the core inflation numbers came out, which obviously don't include energy and food, people were like, well, it's come down, but the things that you need to live aren't included in that. Where do you think interest rates are going to go? How are central banks going to behave from now on? Do you think they're going to go higher for longer? Do you think they're going to sort of stop, pause, and see if things break? We'll start with you, Sharon.
So I guess we've been in the camp that you would not see a deep recession, in fact, any recession in the US, and maybe a very modest one in Europe, and we're still very much of that view. And even next year in 2024, we have 2% US growth, real terms, and in Europe we have sub 1 in Europe, so Europe's still growing much less. But that means that you're not going to see inflation come down to 2 or below 2 anytime soon if you're still seeing that type of expansion. Labour markets are still tight, as Bob mentioned before. We haven't really broken the labour market yet. Now, I'm not sure that rates at the short end need to go up any further. They've already gone up in most places around 500 basis points. So we've had a big rise in interest rates. We think, though, we're of the view that I think it's been described as table mountain or tabletop. We think you've got to this level of rates and you will see a period of rates on hold by the central banks. You won't need to see further hikes from here. We've already had big hikes. We're already starting to see those having a little bit more of an impact on the longer end of the yield curve as well. That's been moving up, tightening conditions as well. Credit spreads have moved up a little bit as well recently. All these things are tightening conditions for investors, for households, for smaller corporates, etc. So I think all of those things mean that they don't need to tighten further from here. Inflation is starting to come down. You mentioned food and energy are the things that people spend on. Even headline inflation is coming down a lot. Yeah. In the UK, headline inflation peaked at over 10, and it's come down a lot from there. But it's still high. We'll be getting an inflation print in the UK this week, and I think our expectations is going to be about 6. So it's still going to be high versus previous periods. So what we're not looking for is rates to do this. They've gone up the mountain and they're going to be cut very quickly. We think that you don't get inflation falling super fast, so central banks will be cautious, keep rates on hold. We're not expecting cuts by the ECB, by the Bank of England, or by the Fed until really the end of 2024.
Okay. Bob?
Well, when you think about why central banks do what they do, and the central bank controls the short-term interest rate, right? So they're always trying to balance multiple objectives. And coming into this period of where they started off with almost a deflationary depression, then you print all the money and then you get an inflation. So when you pumped up that nominal spending, you're going to have some combination of inflation and real growth, and ideally they want 2% inflation and 2% real growth. That's and stable financial markets. That's the goal. And so if you don't have haven't achieved both of those goals, you are playing off one against the other, right? And so at the present time, if you take the U.S. as a starting point, you've got like a 1.5% real growth rate, maybe 2. There's no reason to ease monetary policy because the economy's weak, right? It's pretty normal. And at the same time, the level of inflation is still higher than you want. So if you have the growth rate that you want, but if the inflation rate's too high, there's no reason to cut interest rates. And you might even raise them a little bit, depending on how you think things are playing out. So that means you're in this position where at a 5.25%, 5.5% T-bill rate, no reason to change it. Normally would say, great. The problem with that is that the markets are discounting a big cut. And so if you hold that short-term interest rate at 5.5, and the bond yield was at 3.5, why should you buy a bond if you can get 5.5 in a T-bill and it's going to be there for a while? And so then bond yields start to move higher. So I think you really have to be thinking about the long end and the short end separately. But both of those will be very unusually where they will go will be in the context of the levels of things. So in the markets, we're used to, in the markets mostly it's the changes that drive the changes in markets, and we had a big up in inflation, had a big up in interest rates, then we had a big down in inflation. But that decline in inflation is, the question is now, where's it settling out? Where's the level of inflation? Where's the level of growth? And where are those in the context of central bank goals? And the growth is okay, the level of inflation is too high, and so that just leads you to, on the margin, leave the short-term interest rate where it is. So, and chances are, until you get a crack in profits and until you get a crack in the labor markets, there's not much impetus to cut that interest rate, and that doesn't seem to be imminent, right? So imagine that we're sitting with a 5.5 T-bill rate for the next 3 years. You're not going to stick with now a 4.5 bond yield for very long. So what's happening is, and at the same time, there's a pretty substantial liquidity hole opening up in the U.S. financial markets where you have the draining of liquidity by the central bank at the same time as you have now a big issuance of bonds on the long end of the curve. People are generally not aware that over the last year, there was a big expansion in the fiscal deficit of the United States, but it was funded almost entirely with T-bills. So there was very little long-term borrowing pressure, and most of the financing of these T-bills was excess liquidity produced by the printing of money. So there was really no pressure on the long end of the market as they were raising short-term interest rates. That's reversing now because the funding of the Treasury deficit is going to normalize in terms of the mix. There's going to be more long-term debt issued. And that excess liquidity is gradually coming down. So you combine the fact that the short-term interest rate is much higher than the long rate, you don't get a risk premium in bonds. The central bank is not buying the bonds anymore. It has to clear in the private market, and the private market's going to want a risk premium relative to cash. And so it's not not hard to imagine a 5.5 or 6% bond yield, in that kind of environment. So the main thing, though, is the holding the short-term interest rate where it is, mostly driven by whether the levels of conditions are, where are they in relation to the central bank targets. And then there'll be a different configuration of that in each country, but Europe a little bit different.
Right. I think I want to touch quickly on the wage growth issue, right? Because Sharon and I were discussing this as well, but you have this kind of self-prophesizing cycle where obviously inflation is up, you get wages to go up, and people have more money to spend. And sort of the only way to break that is for people to not have jobs anymore. Is that something that the sort of central bank just has to come to terms with? Do you have to keep hiking until you see this collapse or this sort of break in the employment market?
Yeah. Wages is the key thing at this point for all of these markets, because wages is income. Income gets spent. Spending produces income, which gets spent. And so the unique thing about wages is wages generally forms the center point of inflation. And then goods prices will oscillate around that, but wages tends to be the center point. The reason is it's really mechanical, because if you think about, wage is just a price. It's the price of labor. And all prices are shaped by how much spending there is in relation to quantity. right? So when you had a lot of spending and you hit a low unemployment rate, wage goes up. The question then is, who receives that high price? So wage is the price of labor. When the price is high, who receives that high price? Households. Households receive more money for that because the price is rising, right? That gives them more money to spend, which produces more income because one person's spending is somebody else's income. And so long as so that's why wage inflation tends to be self-reinforcing, is because the spender is the one receiving it and then they spend it, which is very different than, let's say, if oil prices go up. If oil prices go up, who receives that benefit? It's an oil company, and the consumer actually has to take money away from spending in order to pay for the higher oil price. So that it tends to be more, self-reversing, whereas wages tends to be self-reinforcing. And that means that once you're in that loop, it's hard to get out of that loop.
Right, yeah.
And pretty much, like you say, wage is a price. It's a function of supply and demand. And so you really need to, increase the supply of labor by producing a higher unemployment rate in order to change the supply-demand dynamics. And in order to do that, companies have to do that, right? Households do the spending, businesses do the hiring. So as long as businesses are okay, you're going to get hiring, and if you get hiring, you're going to get income, and you're going to get spending. So you have to change the economics and the incentives of businesses in order to soften the labor market, which pretty much requires a contraction in profits. We haven't happened yet.
We haven't had that yet. Sharon, what do you think? Do you think there's an argument to be made for not increasing wages?
Yes, unfortunately, it's quite a bleak prognosis. But
right.
Yes, I kind of agree to some extent that we still see inflation very sticky and high. We still see wages as a big cause of that, very large cause of that. We had UK earnings data out this morning, and there's much fanfare because it's come down, but it's still around 8% wage growth year on year. I mean, that's very high, way above what any central bank would see as sustainable or its target. And I also believe, particularly in Europe, it doesn't just feed on itself because households then spend that money and that adds to profits and adds to hiring and adds to wages. It also feeds on itself because you've got comparisons. The public sector, for example, in the UK will say, okay, the private sector have received this, we want to receive similar as well. And if the labour market's sufficiently tight, which it is across Europe and the UK, it is a relatively tight labour market at the moment, you will see continuous higher wage demands to match the kind of higher inflation that you're seeing. It is a very difficult cycle to get out of. I think the recipe to get out of it is unfortunately higher rates for longer period of time, and you are starting to see wage growth come down, and that's a good sign. In the case of the UK, for example, you've started to see unemployment rise. And although that isn't a good sign, if you're offering your labour out there, it is a good sign in sense of less pressure on the labour market, less pressure on higher wages, which will bring down inflation, which of course is a big problem at the moment. So I think we are solving the problem, but super slowly at the moment, and we just need to do a little bit more for longer, which is why I think rates stay higher for longer. And I agree with Bob, if there's a risk either way, it's probably that they go up rather than that they come down very quickly.
And touching on that, so what is we saw in March, which feels like decades ago, what happened right when interest rates rose. We had the regional banking crisis in the US, triggered by the collapse of Silicon Valley Bank. And so we started to see that there are these weaknesses in the system that are impacted by higher interest rates. Weirdly, it didn't sort of transfer onto anything else. It didn't have any contagion. And then around April, May, we started to talk about this potential crisis in real estate, which again hasn't really fully materialized. What do you think will break if we have rates higher for longer, or indeed if they keep going up? Bob?
Well, the thing I think you need to look at is who has extrapolated the past conditions into the future, and how dependent are they on that, right? So if you think about why those banks were failed, they basically extrapolated a zero interest rate environment into the future. They invested on that basis and bought bonds yielding 1.5%, and then turned out that wasn't true. And they had embedded that bet into their balance sheet, which then, when things shifted, they had those consequences. So I think we're in a major paradigm shift, a regime shift between an environment, initially a deleveraging environment, zero short-term interest rates, very negative real interest rates, and the arbitrage between cash flows for businesses. The arbitrage between cash flows and financing costs was very attractive. And so you had, for over a decade, you had free money, cheap money, to borrow, to buy cash flows, and then you have a leveraging up in the system, right? And you have entire industries built on that.
Private equity, right?
And now all of a sudden, when you change that regime, and you say the T-bill rate's 5.5, and borrowing money is now 8. As you get maturities of the debt and the rollover at the new interest rate, and the credit rating has changed, the ability to get that financing has changed, the flow of liquidity is less. It's more likely to be a grinding process than like a crack in the system. The banking system is reasonably, well capitalized, and fairly liquid. So you're not likely to get you're not likely to get like a bubble popping. Of course, when I say that, that's to say something's not going to happen is like the dumbest thing. But it's more likely, the effects of what you're describing is more likely to be a grinding process that just puts sand in the gears of financial flows.
Not a bang, like a whimper, sort of. Okay. And what do you think the most vulnerable areas are?
Yeah, look, I think it's interesting, and I agree with Bob again on the sort of grinding process. I think if you consider the different economic actors in the economy, so there are households, there are corporates, there are banks, and there's the government. And if you think of us coming out of the pandemic, households actually have very good savings because of the furlough schemes, et cetera. They actually came out of the pandemics with very good balance sheets. They went into it with okay balance sheets. It wasn't like the financial crisis where they'd over-levered themselves. So households were in a good shape. They're still in generally reasonably good shape. And then corporates, non-financial corporates, again, generally not over-levered. If you look at the US and Europe in aggregate, and of course, in the end, there's always a tale of corporates that have taken on too much leverage, but generally not too much leverage. We didn't have an M&A boom in the run-up to the pandemic, or even since then. It's generally been very quiet on that front. So we didn't have overstretching of the non-financial corporate sector. Then let's take the banks, generally well capitalized, as Bob said. And that's because of regulations from previous crises, from the financial crisis, from the sovereign crisis in Europe. Banks' capital ratios have been very good. We generally haven't seen big breaking there. I mean, there have been some examples, but nothing systemic, because banks have been much better capitalized. And then that leaves the final economic actor, which is the government. Now that is where the debt is, unfortunately. They built up this debt through the pandemic, very generous furlough schemes, already quite indebted anyway. The government has a lot of debt. Now, in some ways that's good, because governments generally, you don't get the sort of bailiffs at the door of the government immediately. So it takes a long, long time. Again, it's a bit this death by 1,000 interest rate hikes or higher rates, because the government can finance itself, but in order to get those flows in, it's going to mean higher yields that they have to offer for longer. So I think government, and you see this, Italy perhaps is a classic example of a more vulnerable sovereign in Europe. Its debt to GDP is something like 150%. It's not coming down. Even though we've had very high nominal growth recently, even though the EU is transferring money to Italy via the recovery fund monies, actually Italy's debt to GDP is still stubbornly high, and that's going to be difficult to finance, and the market, that may eventually become a pressure point. The other way that government debt, of course, can become a pressure point on companies, and you see this a lot in Europe, is more taxation, windfall taxes, corporate taxes. So again, governments, of course, have the ultimate power to raise taxes. So again, it might not be a collapse in anything, it might just be governments which are overburdened with debt sort of sucking in the capital of the economy to pay for that debt over time. So yeah, I think that is the most vulnerable economic actor, and it's good news in some ways because governments don't tend to break very easily, not in developed markets, but bad news probably longer term, because it means rates stay higher for longer.
Right.
It could be currency effects too.
Yeah, I think we are out of time, but Bob and Sharon will be here. Thank you so much for joining us. Thank you.
Good, thank you.
Thank you.